Good morning, everyone. My name's Phil Anderson. I'm the CEO of the AFA. We're joined this morning by Michael van Niekerk. On the presentation today is Responsible Investment and Impact. Michael is the Chief Impact Officer at North Star Impact Funds. He's also the founding director of independent responsible investment advisory firm Peak View Strategy. Michael has 30 years experience in the corporate and financial services space, having worked previously at AMP and done consulting work for a number of super funds. Michael, if you could flick to the next slide, I'll quickly provide the context. Today is the webinar. We'll have 1 hour CPD available, and we'll send those details to you at some stage over the next week. Now, all participants in the webinar will be on mute throughout the session, but you will have the opportunity to ask questions. And at the end of the session, we've reserved some time for a Q&A session. However, I ask that you use the Q&A button and not the chat button for that purpose. So I'll hand over to Michael to kick off with the presentation. Thank you, Michael.
Thanks very much, Phil, and thank you everyone for the opportunity to speak to you today. Phil's kind of outlined the title of the presentation, which I hope to do for the best part of 45 minutes. Hopefully you'll find it very interesting, and then we'll have 10-15 minutes for Q&A after that. So what I'm hoping to do is break it into three parts. Really talk about what is responsible investment. There's obviously a lot of growth in the market. Clients are demanding more around what they call ESG, but there's also lots of confusion about terms and definitions. So I want to kind of go into the market construct of responsible investment. So we talk about ESG and impact and all these other terms, and then look at where the market's going, the size and the growth, and then a couple of trends and market developments. And then I guess maybe from your perspectives as advisors, what's going on from consumer investor preferences? What are they wanting? What do they don't want? What are their demands? And then thirdly, just going to do a deep dive into impact investing, which is one of the strategies across the responsible investment spectrum. So why don't we kind of kick off with that and look at the market construct. So this first chart here really shows the responsible investment spectrum. This spectrum, or these categories of responsible investment, is used not only in Australia but globally. So there's a uniform categorization. There is obviously blurring between the different styles, but let me quickly take you through what this chart's all about. You can see it's bookended on the left-hand side by traditional investment. So let's put that to one side. And on the right-hand side, philanthropy, which is really seen as giving, not investing. So there's no return coming out of philanthropy. Then we've got 7 different strategies or styles of impact investing, ranging from impact investing on the right-hand side and ESG integration on the left-hand side. In between that, you've kind of got exclusionary or negative screening. On the right-hand side, you've got positive or best-in-class screening, then norms-based screening, and corporate engagement and shareholder action, which is the category in the middle. Also on the right-hand side, which very close to the positive screening, is sustainability-themed investing as well. And that's now starting to blur in with impact investing. I'll go through some of the definitions on the next slide, but just to finish off this particular chart, which I think is useful if anyone ever wants to kind of really understand the definitions, always kind of refer back to the slide. But you can see the 3 bars that sit below. The first one is avoids harm. So you can see all the strategies, even into philanthropy, avoids harm, and we'll go into a little bit of that in the definitional space. The second bar you can see kind of runs from norms-based screening all the way through to philanthropy, is benefits the stakeholders, and then the the third bar is contributes to solutions, and that's very much what philanthropy and impact investing is all about, even though that bleeds into sustainable themed investing. All right, hopefully that makes sense to everyone. I might just add, the three comments on the top of that chart there shows that the ESG, which is talked about in a lot of the media, it's all very risk-based. So a lot of the ESG investing, you might have some of the banks, you might have some of the big miners like BHP in there. A lot of people in the value-based investing will think that those aren't really responsible investments. They're mining, they're extractive. What are the banks doing? Given the financial services inquiry that we've just been through, why are they in a portfolio? But it's really risk-based. So you're looking at the E, S, and G risks, and those might still hold into a particular portfolio. The exclusionary strategies and the positive screens, those are values-based. What I mean by that is, if you've got an aversion to alcohol, for example, or tobacco, you might want those excluded from your portfolio. Those values might not hold for everyone. And so a number of these strategies will exclude tobacco and alcohol and a whole range of things. Some might not exclude those things. So they're very values-based. And likewise for the positive screens, what you choose to put in a positively or theme-based investment portfolio is according to the kinds of things that you might want to be investing. It might be a water fund or a renewables fund. So it's kind of got a positive theme. Similarly, if we look at the solutions-based strategies, the themed investing and impact investing, those are strategies designed to make a positive impact in a particular area. I'm part of a fund called North Star Impact. We use the Sustainable Development Goals to invest in 10 particular positive themes: education, healthcare, renewables, childcare, and a bunch of other themes, all based on the Sustainable Development Goals. But all our companies are having a positive impact in providing solutions to either environmental or social problems. Moving on to the next slide, kind of goes into a little bit of what I have been talking about, the definitions. So let's just quickly look at ESG. This is the explicit and systematic inclusion of ESG issues or factors in the investment analysis and investment decisions. I would argue a lot of this has always been done, and there's obviously a lot of money that's flown into the ESG strategies over the last 4 or 5 years. Momentum's been building. There, according to an Economist article, there's $50 trillion that's flowed into ESG over the last decade. And that's obviously gained momentum in the last few years, but lots of money flowing into that strategy. Negative screens, as I mentioned, the exclusion of certain sectors or companies based on controversial business activities or practices such as armaments, tobacco, alcohol, gambling, pornography, all those types of things. And as I mentioned, it's values-based, so it could include coal, gas, and other fossil fuels, depending on the investors or the investment managers' values and what they're trying to achieve. I've talked a little bit about the positive screen, the definitions there on the screen. Impact investing is one, probably just to slow down a bit, because there's quite a lot of confusion, I think, in the market on that. Basically, impact investing is investing for solutions, and it's really solutions around environmental or social problems. There's 3 requirements for impact investing. One, there needs to be intentionality, both from the investor and the investee company around providing that solution and making a difference. Secondly, there needs to be what they call contribution or additionality. So you need to be bringing something new to those problems, whether it's capital or technical assistance, so making a real noticeable difference or a tangible difference. And the third important differentiator, which makes it different to all the other strategies, is that impact needs to be measured. clearly, all these strategies cut across all asset classes, and later on in the presentation, we'll talk about products and solutions, and what are some of the strategies in the markets. This slide hopefully helps clarify. I won't dwell on it, but hopefully will help clarify some of the points I've been making earlier on in the presentation. You can see the four major categories of responsible investment styles. All of the strategies have exclusions. They exclude bad practices. What they call the A, B, and C, avoid harm, benefit stakeholders, and contribute solutions. I went through on that first slide, but you can see impact investing ticks the box for all those, but not necessarily some of the other strategies. And then clearly, just to make the point again around impact investing, the measurement and the reporting, they're the only ones that really do that. So that makes it quite a distinct strategy. I might just make a comment at this point around greenwashing. Clearly, there's a lot of discussion in the market about greenwashing on ESG funds in particular, but there's impact washing, there's SDG washing, there's greenwashing, all sorts of claims around funds not being true to label. One of the things that I think and clearly the regulators now looking at this, European regulators, the SEC in the US have been looking at various funds as well, but in Australia, ASIC has been in the media looking at various organizations and funds around claims of greenwashing. So there is obviously a lot of attention being paid to funds that are not true to label. Now, just on the market and the size and the growth of the market, a lot of this research has come out of RIA, which is the Responsible Investment Association of Australasia. They do an annual benchmark study, and you can see a lot of the trends coming out of those reports that they produce. But just having a look at the total market. So today, the responsible investment market, so that's all those different strategies, is about $1.5 trillion, which is 43% of the total market. That's increased steadily in terms of percentage terms from 2019, only a couple of years ago, 3 years ago, from 19% of the market to now 43%. So you can see that the responsible investment strategies are really starting to eat into the total market. ESG integration is the big player where all the money is flowing. You can see in the chart on the right-hand side, now up at 752 billion. What's interesting to note is the second round bubble there, corporate engagement and stakeholder action. There's a lot of the super funds and the asset managers now engaging with companies around issues on climate change, on biodiversity, on alcohol, on a whole range of topics. Investors are joining groups and engaging with companies through groups like AXI. Other private activist groups are starting to gather funds together to engage companies. So you can see a big shift in that market. The other one that I think has made a big shift is the sustainable themed investing. That's gone up to 161 billion, almost doubling from 76 billion just in 2020. And I'll make some further comments about that in a minute. When we look at exclusions, you can see in the chart there on the left-hand side where most of the exclusions are, where the movements have been between 2020 and sorry, that's not the year movement. It's the movement, the difference between the managers and consumer preferences, which is again very interesting. On the left-hand side, clearly fossil fuels is the big exclusion we're seeing right now. On the right-hand side, we see tobacco as as a big exclusion, particularly from fund managers. But when we look at the small green bar on the left-hand side from the consumer perspective, and their searches, there's not a lot. That's primarily because we don't have a lot of tobacco companies in Australia, and it's really the likes of Woolworths and Coles and those kinds of organisations distributing cigarettes and tobacco. So while a lot of the big fund managers are making the exclusions, consumers are not that concerned about that in their portfolios. You know, the second biggest category from the consumer's perspective is human rights abuses, which we can see on the left-hand side of that chart. In terms of investment themes, again, big shifts in the last year, and this research was published kind of the middle of this year in 2022, but relates to 2021 figures. I think this has moved in the last 12 months as well, but climate change is the big theme of the day and seems to be crowding out a lot of other themes. And biodiversity is the one that's coming through very fast. You can see in 2020, those numbers were very small. Biodiversity, which is kind of made up of the two red bubbles below the climate change one there, sustainable land management, and then sustainable water, healthy rivers and oceans, biodiversity conservation, natural capital. Those have really come into the fore in the 2021 year. So those are the big themes for investing that have come through. This chart on performance of the funds, it's very busy, a lot of numbers, but let me just pause and step you through what's here and make the obvious comment. If you look at the green, there's basically been outperformance in the listed market of the responsible investment strategies. On the left-hand side, you can see the titles there. There's three broad strategies that this data pertains to. There's managed growth, international equities, and Aussie equities. And then we've got bars of data relating to 2022, the four bars on the left-hand side, and then 4 bars relating to 2021, and that's obviously 1, 3, 5, and 10-year performance in each of those. And then the top 2 lines of each of those categories of managed growth, international and Aussie equity show the first line is the RIA certified product. That's the for that strategy. The second one is the responsible investment fund average for across the categories. These are Morningstar fund data. And then the third one is the traditional funds around Morningstar. And basically, you can see in 2021 and to some extent in 2020, the green showing outperformance, the yellow bars are showing on par with market, and the grey showing below. So there's a couple of blocks there of grey when compared against the Morningstar figures. Again, that's probably one just to dwell on post the webinar. I'll leave it at that from here. Just before we kind of go on to the next section, I thought I'd just highlight some of the kind of big trends that I'm seeing across responsible investment and sustainability to some extent. So let's just quickly step through those. Decarbonisation and electrification of everything, and corporate commitments and pathways to net zero. I mean, this is all over the media, in the AFR. This is what everyone's talking about. All the consultants are trying to help companies do this and decarbonize the economy. Lots of funding coming out of the Clean Energy Finance Corporation, research trials coming out of ARENA, all being funded. All the states are doing hydrogen projects, a big push on decarbonisation. Clearly, it's being caught up in politics. Labour have come out with their new targets in the last few months. There's a lot of momentum around that. In financial services, a lot of increasing regulation, well, beyond financial services into industries as well, but increased regulation, standards and reporting requirements. The big one around climate is the TCFD, and its sister a set of regulatory requirements, the TNFD, which is around nature. That's still being worked through and in draft form. These are reporting requirements that are both voluntary in Australia today. Sorry, TNFD is not mandated or being reported on officially at this stage, but TCFD is. This is the Task Force for Climate Risk Disclosure. So companies really setting out their exposure to the risk of climate change. These are voluntary for listed companies. A lot of the top 50 are now reporting on this basis because they know it's coming. In fact, New Zealand is requiring it from 2023. It's going to be made compulsory. So I suspect within the next 5 years, it'll be compulsory within Australia as well. But there are a lot of other reporting requirements on corporates and funds. And this is, definitely requiring funds and companies in the sustainability area to hire more people to deal with all this reporting. As I mentioned earlier, as we saw the numbers, big flows of money into ESG and other strategies. I've made mention of greenwashing across all sorts of different strategies. The biodiversity strategy, the biodiversity thematic is coming through in a big way. My view is there's not a lot of investable solutions at this stage, but a lot of things are working through. People might have read some of the controversy around carbon credits and nature credits, biodiversity credits. In the media in the last 6 months, the ACCUs or the Australian carbon credit market has been discredited in terms of its the validity and the underpinnings of some of those carbon credits, even though the Clean Energy Regulator that oversees the official market, this is not the voluntary market, but they're kind of standing behind those, but also reviewing their methodologies. But I think the nature-based solutions and the markets that go with it are coming, and those will develop quite rapidly in the next few years. Diversity, it's certainly a big trend, but I think 2021 and 2020 was the year around gender and racial diversity with the Me Too movement and all those issues. So, I think there's a long way to go on gender diversity, but a lot of companies are being confronted by the big fund managers and the super funds on diversity and how they score on those things. Clearly, pollution, the circular economy and regeneration, so repairing nature, restoring carbon into soils, all those things, everything, reuse, recycle, regenerate is a big thematic that's coming through. And clearly, companies are all having to get with the program and start to become more sustainable. Even in the private equity market, we've seen companies thinking about their sustainability when private equity managers are buying companies, when they needing to sell those in 3, 5, 10 years' time, they've got to be selling sustainable businesses in order to retain that value. In terms of kind of sustainability sector thematics, renewables is obviously the big one, obviously attached with climate change and biodiversity. Closely all integrated in that is food and the food system and the future of food. I mean, there's a large carbon footprint. Clearly it affects natural systems, whether it's clearing land for agriculture. The food sector is a big one, and transport, whether that's air vehicles, electrification of vehicles, trains, shipping, all those forms of transport are very big themes. And then lastly, what we'll talk about later in the presentation is impact and impact investing. All right. Quickly, let's run through, before we get on to impact, some of the consumer preferences and investor preferences. Interestingly enough, most Australians, well, 86%, expect their super and other investments to be invested responsibly. I think that's a very high number, and a lot of funds are not necessarily doing that. The super funds are very aware of this and starting to engage their members on these things and thinking about the investment managers. Most would be going down the ESG path and certainly thinking about impact. In terms of people wanting to actively think about their investments, most are starting to think about it, and this trend is rapidly moving. In terms of performance, this is one of the big questions: have responsible funds outperformed traditional funds? We went through some data earlier, but it's quite interesting that 62% of Australians believe that ethical and responsible funds perform better, and that's up from 29% just in 2017. I think this final comment, around 80% of Australians think that the financial services sector should consider social and environmental impacts, despite that might even deliver lower returns, kind of contradicts the figure above. But there's obviously a lot of debate around fiduciary duty. Clearly, investment managers and super funds need to be thinking about investment returns first. So giving up returns is obviously not carrying out those duties, but to find investments obviously that are delivering returns and delivering ESG or responsible outcomes is the key. Where are people looking? Most people are thinking, 80% think the environment's the most important, 64% are thinking social issues are. You can read down there some of the most individual themes: renewable energy, I've mentioned. Sustainable water management and use, I think, is an interesting one that's quite high. Healthcare, medical products, oceans and rivers, sustainable agriculture, land and education are some of the high figures there. In terms of avoiding issues, again, environment tops that. Interestingly, animal cruelty comes in second, then tobacco and alcohol, and rights violations. Again, the specific topics: animal cruelty is high, tobacco, weapons, human rights abuses and gambling are all between 50 and 60% of respondents on that research. Right, on to the third and final section on impact investing. Let me just start with the mega trends. This is international trends. So impact investing is relatively small, and we'll see the Australian figures in a minute, but a relatively small in terms of AUM segment of the market, but it's a very fast growing segment. And you can see the outlook there, 30% growth between 2020 and 2025. Clearly those numbers are a little dated, but you can see that the numbers there, the market's looking to grow from 123 billion 2020, let's say it's 150 plus now, towards 700 billion by 2025, and a 30% CAGR there. This is kind of implying, in terms of an overall allocation around responsible investment, going from 6% in 2020 to 11% of the total allocation in 2025. Looking at the Australian market, the numbers on this chart show a growth from 1.9 billion in 2015 to 29 billion in 2020. The orange bar is the number of products, so there's a proliferation of products going on at the same time. We do have the 2021 figure, which is only up $1 billion to 30 billion. And obviously, there's the outlook coming forward, and I'll talk a little bit about the triggers for the growth in the market in a minute. This is kind of a drill down into what's going on within that from a product perspective and a strategy perspective across asset classes. Most of the money is going into green and social bonds, 26 of the 29 billion. But in the last year and in 2021, we saw quite a big push into renewables and disability housing and other social housing funds. In terms of triggers, with the previous government, under Scott Morrison, there's a social impact task force that was set up. Michael Trail, ex-Macquarie, bank executive who's done a lot of work in the impact space, has headed that up. One of the key recommendations, which are now actually being dusted off under the Albanese government, he's been tasked to come back before the next budget with a dusted off set of recommendations, but one of the key recommendations to set up a $400 million wholesale warehouse for social impact investing. So this excludes environmental impact, which is really being looked after, I think, by the Clean Energy Finance Corporation and ARENA. So there's 10 billion gone into the Clean Energy Finance Corporation and about 2.8, I think it is, into ARENA. So there's quite a lot of capital gone into those organizations and into funds from there. So this is really about looking after the social impact segment. They're talking to the big four banks and I think some of the super funds to put money into that wholesaler. The other development that could see the growth in the market is, I know of 2 super funds, and there's probably more, looking to get mandates for super mandates in, both of them are looking at north $100 million mandates across asset classes for impact investing, and looking for advisors to help them set those mandates up. Let me go on to the next slide from here. This is again a busy slide, and I'll leave it to you to kind of look at after the presentation, but really shows the examples of products across those various strategies that make up the 29 billion. Again, this is kind of sourced from RIA. I made mention of the green and social bonds and sustainable bonds, but a lot of strategies in real assets there as well, relating to renewables, water funds, agri funds, disability housing funds. What else have we got there? Yeah, wind farms, solar farms. Yep. In terms of the largest funds in Australia, there's a couple just to note there. Altius have a large $830 million sustainable bond fund. Leapfrog, they don't do a lot of investing in Australia, but mainly into developing markets, but the fund is based here. It's a private equity impact fund. They're on to, I think, their 3rd fund, which is circa 500 million plus. Pendle and Regnan, they've got a number of funds, an impact credit trust, and a global impact fund as well. And then SVA does work in social funds. They're about $120 million. All those funds are based in Sydney. Quickly on this, I mentioned the Clean Energy Finance Corporation. These are government-supported funds for impact investing. Clean Energy Finance Corporation, NEFIC, ARENA, and T Corp. T Corp have issued a large green bond, 1.3 billion. And I've made mention of some of those other funds earlier in the presentation. So where is the interest in impact investing? I think if we look at where it's moved, we touched on the numbers going from 1.5 billion back in 2015 and up at 30 billion now. We can see the shift there from those that are interested and very interested in the chart on the left-hand side, really moving from 14% from those very interested to 33%. And then you can see the breakup further on between the different channels, between family offices, trusts, and investment managers and asset owners. And again, the thematics, clean energy and housing and homelessness are strong. That comes out of the chart on the right-hand side. Where the fund is allocated, the chart on the left-hand side, what we're seeing certainly with our clients is people start out by maybe doing listed equities impact, maybe an ETF, 5 to 10% of their portfolio, and then grow from there. There are a few family offices that have chosen to do 100% impact, but the figure up there, we've got 27, so a quarter roughly have more than 50% of their allocations to impact. From our experience, people start with it. They start to get the reports because they're measuring the impact. They get the impact reports. People connect with the companies because they have a lot of purpose. They understand what they're doing. Advisors then are able to talk to their clients about the impact that these companies are having, as well as obviously the financial returns. There's a discussion to be had there. The allocations then grow from there and then proliferate into other asset classes. I think the kind of the major drivers I think are really around looking at a company's mission. So people might start maybe with one stock or one strategy, thinking about its mission or what it's trying to achieve, what's the impact it's trying to achieve, is kind of one of the key drivers for going into impact. So it's kind of mission or intent led. And then, the research shows, the measurement of impact. So you can actually see there's a tangible impact as well as the returns is another driver for people going into impact investing. In terms of asset classes, the kind of key ones seem to be private equity and venture capital, real assets and pay performance. Those are typically the smaller strategies. As we saw earlier on, the green bond market is one that's really taken off. And the space that we're in, listed equities, it's small but growing quite fast and quite easily accessible. In terms of where people prefer to the kinds of companies, clearly there's a tendency towards focusing on more mature companies and growth companies rather than the earlier stage riskier stuff in seed and venture capital. In terms of financial expectations, financial return expectations, most investors are seeking market-based returns, plus the impact, obviously. And a small part, 10%, are happy with lower than market returns. And what we're seeing is, most of the investments are meeting those needs of returns, and 26% are outperforming expectations. That's it from me from a presentation perspective. Very happy to talk further and take questions. Phil, can I hand back to you?
Thank you, Michael, and thank you for a very informative presentation. We do have some time for questions, so I encourage anyone who's got some questions to put them through the Q&A function. But Michael, I might kick off with a question. This week has been a budget week, first budget from the new Albanese government. Did you see anything in there that had a particular ESG theme to it? And have you got broader comments on that?
I haven't looked at the budget closely to comment on that, Phil. So no, I haven't seen anything particular. However, I have seen the Treasurer made a comment that he's on the impact space. He's very keen for the superannuation industry to support renewables and the housing thematics. Clearly, two big challenges facing the economy, and looking for superannuation funding to get behind those two themes. So I think that kind of dovetails into the task force work on social impact, certainly on the housing side.
Yeah, Michael, I think you're right. One of the key announcements, although it seems to have still quite a bit of work to do, is that 1 million new homes and how the government is going to work with the private sector to achieve that. Okay, another question for you is, licensees have a very important role in determining which products financial advisors can recommend given the approved product list. What are you seeing in terms of licensees and the extent to which they are adopting ESG investment options? Are they leading or are they lagging in this respect?
I'm not sure about the leading and the lagging, but clearly some are leading. I mean, we've seen some of the large wealth managers, the likes of Crestone, Coda, they certainly lead and got people really advocating for responsible investment and in particular impact investing. And then it's quite ad hoc. I mean, I think there's a group called the Ethical Advisors Co-op that we work with very closely. They're a scattering of advisors across the country as a co-op. Clearly, they are strong on the space, and I think next week there's Ethical Investing Week, and they have a whole set of a whole program around that. And then clearly, the IFAs are dipping their toes in. We get queries through our distribution around what we're doing. But I think there's a long way to go. And, I think hopefully this webinar is giving some idea of, how the market is growing, but also how it's constructed. So people have a better way of doing that. A number of the platforms, NetWealth and Hub24, have a range of products on their platform. So depending on how people are advisors are coming into the market. And then, I think in the private equity space, I think it's quite difficult, especially those closed-end funds. They'll raise a certain amount of money if the licensees have access to those fund managers who are looking to raise money at that particular point. Then they can get access to that product, but then it's kind of gone. Some open-ended funds, obviously, people can come in at a later stage, but I guess if people are interested, then it's a case of understanding who's in the market and what products are there. I might just make a plug for RIA, the Responsible Investment Association of Australasia that I mentioned earlier. They've got a part of their website called Responsible Returns, which is all their certified products. So across all asset classes, so advisors can go and look at those products and they certify them. And the certification is quite a rigorous process. So they should hold up pretty well, but that's a good way to look at quality and to avoid the greenwashing issue. Yeah, I think understanding who's in the market is the first port of call, and which strategies kind of suit the needs of the client. Our sense is, most practices, most licensees might have 5, 10, 15% of their clients who are interested in investing responsibly. Clearly, that's growing from the research that I ran through earlier. But unless you're you've got the flag up saying you're an ethical advisor group or licensee, and attracting those kinds of clients, most might have, that kind of percentage who are wanting to think about these kinds of products. Let me leave it there.
Okay, Michael, you made it really clear through some of the slides that you presented that clients are taking a much greater lead in terms of their expectations of where their money is invested. For an advisor who's relatively new to this and has not got a lot of experience in engaging with their clients on ESG issues, what advice do you have about how they can incorporate ESG into their business model and the conversations that they're having?
Yeah, I mean, clearly, understanding clients' needs is the first step in understanding, the classic stuff of risk appetite and doing all that work. And I think, to the presentation, understanding the construct of the market and what products are available, there might not be the products available to suit the particular client's portfolio, but there are products across all asset classes now. And I suspect, one of the steps might be if the client is wanting to make a step in that right direction, there might be a couple of products that have been with good ratings, investment grade plus, highly recommended, to put the toe in the water there, or through one of the ETFs. But to the point about greenwashing, the thing that we say to people is, look what's under the cover. You want to look at, especially if you're taking an ethical approach, you want to be looking at the holdings in those companies. We see a lot of products that claim to be impact or sustainable or ESG, and it's not true to label. So that's the first thing I'd say. Depending on how the client thinks about it, and they want to kind of go through the holdings in the particular product, that might kind of reveal that. With the RIA certification, people are required to disclose their holdings. So, top 5 holdings, top 10 holdings kind of doesn't do it. But the RIA certified products, clearly you've got to disclose all your holdings, because these things are important. It's no use having a very small holdings of a tobacco company when a client's got an aversion to tobacco. You want to completely exclude it. And that RIA website, the responsible returns tool, you can click certain boxes and exclude tobacco, exclude alcohol, exclude pornography, whatever it is, and then run the tool to bring up a set of products that has those exclusions, for example, if the client doesn't want that. But I would say, as I mentioned earlier, probably the best way is to start early, unless the client wants to make that full leap and say 20% of the portfolio or 50%, or, I want out of these things. I want my whole portfolio transition to be sustainable, responsible, or impact, or whatever the label is, and then to work through, well, what does that mean per the definitions and the categorization I talked to up front in the presentation. But I think for the advisors, the first thing is to understand what are the different styles, and then be able to explain that to the client, understand what they want, and then kind of go from there from a risk, return, and impact perspective. Hope that makes sense.
Right. And just one last question. You showed during your presentation very strong performance by ESG investments. You showed 2020 and 2021. 22 has been a year of significant changes in the global economy. We've seen the war in the Ukraine. We've seen inflation rise substantially. Do we have at this stage any indication on how ESG funds have performed relative to the market in 2022?
I certainly don't have the data. I don't think it's been run. I mean, 2022's close. I haven't seen any of the data, but I suspect those that have excluded fossil fuels, for example, probably underperform the market if you think about gas and coal prices. But, there's many different styles that don't, necessarily exclude that. Certainly the ESG funds might have held up better than some of the strong exclusion funds that might exclude those particular sectors. But the whole market's been trashed. Obviously, tech went through a difficult time as well. A lot of the sustainable funds have a lot of the tech stocks in. Clearly, as impact investors, we don't have those. We don't have any of strong exclusions. We're solutions focused, just healthcare and renewables and all those things. So we have very, very little exposure to tech, and so we kind of outperformed the market. Certainly to 30th of June, we performed pretty well. To benchmark, I should say, but down overall. But it will be interesting to see the 2022 numbers. Unfortunately, the RIA benchmarking work is roughly a year behind, right? It doesn't report straight away on performance. I can certainly make some inquiries and see if they run the numbers and send them through. And if you're happy to post them up on your website, happy to try and dig those out. Or people can contact me directly. I can go back to RIA and see if they run the numbers.
Great. Well, thank you for that. And thank you for your presentation and answering the questions. Really appreciate the time you've given us. We might wrap it up at that. So the webinar recording will be available, including the presentation slides. And for those who haven't come along today, they will have the opportunity to watch that recording on our website at afa.asn.au. Those who have participated will receive an email of confirmation, and there will be CPD certificates provided. If you do have any questions with respect to today, then by all means contact Michael, but otherwise contact the AFA at info@afa.asn.au. I'll take one last chance to thank Michael for his presentation today and look forward to seeing you at future AFA webinars. Thank you very much.